Hey guys, this is Casey here. I'm going to cover ETFs and ETNs with you today, volatility, and I know I covered that in another video. Today I'm going to go in a little bit more in depth and explain things such as contango and backwardation with you. I'm also going to cover the VIX, and then just kind of explain the difference between ETFs and ETNs. Okay, so getting started here, I went out yesterday on Google, did a research, keyword research on ETF sectors, and there's 389 sector ETFs. Okay, so there's quite a few, not enough time to cover, even 5 of them really. So I'm going to stick with what I know and what, I'm interested in and what's working for me as far as day trading with volatility. Now, I told you that ETFs are funds. Alright, so they basically hold a pool of either options contracts or mining companies or energy companies, stuff like that. That's what ETF is. It's a fund. And it has a share price attached to it. But I wanted to cover volatility ETFs because the funds on these volatility ETFs are options contracts. Okay? So people are going in, banking institutions are going into the options market, they're making puts. Remember, put is when the market goes down, or when the price goes down. A call is when the price is going up. So they place puts and calls in options, and those are, option contracts. And so that's what your fund is. Your volatility fund is options contracts that these people are putting in. And they deal with future prices. Okay? Now, I had mentioned earlier in a previous video, contango and backwardation. These are things that you are going to encounter with volatility ETFs if you're doing some day trading. So let me go ahead and explain those real quick. Contango is going to be when your buy price, is lower than what your future price is going to be. So in theory, basically your ETF, because you're buying in low and it's increasing in value over, say, like 3 or 4 months, your ETF is gaining value over time. Alright? Now, backwardation, on the other hand, is when you're buying in on your ETF price and the buy-in price is going to be higher than what your future price is. So in other words, your ETF that you're buying, if you're holding on to it for, say, like more than 3 or 4 months, it's going to lose value if it's in backwardation. Again, most of the time these are in contango. Every now and then, though, they will go into backwardation. Now, how do you tell? Honestly, I don't really know. I've done some research on that, and I've looked, trying to find out how you would know if it's in backwardation versus contango. The only thing that I can come up with right now is the fact that these volatility ETFs, and actually, I misspelled volatility, so I'm going to go ahead and correct that real quick, because I know that bothers some people. Should be an A, volatility. Some of these volatility ETFs are attached to the VIX. And what the VIX is, it's basically the heartbeat. Some people refer to it as the heartbeat of the market, and then others will refer to it as the fear indicator. So how high is the fear in the market? They'll go to the VIX, which is basically just a point system. And so what I was to answer the question of how would you know if your ETF's in contango or backwardation, the only thing I can come up with right now is looking at the point system on the VIX. Alright? And I'm not going to get into that because honestly, to tell you the truth, I don't care. I'm in and out. I play it short term versus long term, so really I don't have to worry about backwardation that much. But if you are somebody who is playing volatility and you're making long trades and you're holding an ETF for more than like, say, a month, you're going to probably encounter some backwardation, and then come tax time, you might end up taking some losses, and your trade might end up turning and going south on you a little bit, just simply due to the fact there's backwardation involved. So some of your profits might be eaten up by the fact that your ETF is losing value. Don't quote me on that because I'm not 100% certain, but I went out to read articles from other traders who have been doing some stuff on the VIX and playing volatility with some of the different pro shares and ETFs, and some of them on like Seeking Alpha, which is just a company that writes articles on volatility and all sorts of different other trading strategies and stocks and stuff like that. Some of these comments that are left in Seeking Alpha articles on volatility are saying just that. So yeah, if you're playing volatility ETFs, my advice to you would be don't play it long term. Just get in and out. And there's ETFs that are short term, there's ETFs that are long term. You'll find that out if you go look at Chicago Board of Exchange. If you go to their website, type in pro shares, and it'll come up the whole list of these volatility ETFs, and it'll explain what they do, it'll explain the taxes on them, and that is all stuff that you want to do when you're trading. You want to know your investment. So I highly advise doing that first before you even put money on the table. I know for me, I literally researched and monitored and did simulation trades on these volatility ETFs that I had selected for myself and watched them. I didn't even put money on the table for at least 2 years. So I tested and tested and tested, trying to make sure that my strategy worked. And sure enough, it did, in time. That's another story. I basically, here at the beginning of 2015, decided to put money on the table with my simulated trade scenario that I, watched, monitored, and tested over and over and over again. And from January to now, I have a 80% win rate on my volatility strategy that I'm using, which deals with the VIX and the point system. So, yeah, I mean, you can make some good money with it. I know a lot of people who are six-figure investors using volatility and using strategies in the volatility. And I'm not going to get into my strategy in detail. That's something that I'm still testing in the testing phase. So I'll probably do a good 6 months more of trading with my strategy just to make sure it works before I even present something like that to the public. But 80% win rate. I'm pretty pleased with the strategy that I have right now, and I know that what I'm talking about here, it does work, and it makes you some really good money. So that's ETFs on volatility. I'm going to cover ETNs real quick for you. So we'll get over here to the ETNs. I'll explain the difference between those and as opposed to the ETFs. All right. ETNs are exchange traded notes. So these are exchange traded funds, which are funds. These over here are notes. So it would be like and when I say a note, I'm talking about like a treasury note. You go invest in U.S. debt. What do they give you? They give you a treasury note or a bond. That's what a note is. So ETNs are they're not bonds, but just to give you an analogy of what a note is, physical note, that's what a physical note is. ETNs, on the other hand, are exchange traded notes. You can go with iPath Exchange ETNs, or you can go back with the ProShares again, because ProShares deal with both ETF and ETNs, and so does iPath Exchange. I think both of them do. Don't quote me on that. Go and look for yourself. but I'm pretty sure they both do. Now, if you go to finra.org, FINRA.org, that will give you some great details and lay out basically what the definition of an exchange traded note is. So if you want more information on ETNs, go to finra.org. They do carry more risk than an exchange traded fund. I know in a previous video I covered liquidity, which would be accessible cash that is backing these funds or financing these funds. And I want to get into that real quick with you because that's where the risk is on exchange traded notes. Exchange traded notes are senior unsecured debt security. Now you're probably asking, what the hell is that? I don't know what that is. Well, I didn't either, so I had to go out and look. But a senior unsecured debt security basically is the equivalent of whoever's issuing the note. I'll go ahead and explain it real quick as the best I can. Your banks, right? Your financial institutions will be considered issuers of credit. Okay? Now they issue credit for these exchange traded notes. And so when they say they're unsecured debt securities, basically what they're saying is that the issuer, which would be your bank that is issuing the credit for the exchange traded note, they can default on the note anytime. So in other words, if you're in a trade, say for like 3 or 4 months, and the bank or the issuer of the credit for that note decides that they're going to default on it and they don't want to back it anymore or finance it, they'll go ahead and cut it and it's done. It's done, like immediately. So guess what? You're in this trade, all of a sudden you're out money. Like you've lost everything. You're back down to zero. So I highly advise that you guys look into that. Now I don't know, you're never going to know for sure if it's going to be financed or backed at all times, or I wouldn't worry about that per se, but if you're going to trade with ETNs, I'd stay away from long term, that's for sure. Because the last thing you want is to be in a trade and your issuer that is issuing the credit for that ETN note just cuts it. So you want to stay away from that. Don't do any long-term trading with ETNs. That's my advice. You don't have to listen to me. You can do what you want, but I'm just saying. The other thing with ETNs is they don't own anything that they are tracking. Okay? In other words, with volatility, it tracks the VIX. It tracks the heartbeat in the market. Alright? ETNs don't do that at all. And that's basically the difference between ETFs and ETNs, guys. Again, like I said, go out, do some research, finra.org, look up ETNs, find out what they are if you want to know more in detail. Go to ProShares, alright, type in ProShares or Chicago Board of Exchange, go to their little search menu bar, type in ProShares. You can come up with a big list of all the different volatility ETFs out there that you can use, and each one of them does something different. Alright? The other thing that I would recommend is if you're going to get into volatility trading, do simulated trades first. Okay, so get something like, I use freestockcharts.com and Google Finance, and I set up a portfolio on Google Finance with the stocks that I'm planning on using, and I monitor them day in, day out. I watch them, find out how they react or interact with the markets on a day-to-day basis. And then I look at I've got a tool that I use. I actually had to pay for this from Insider on Wall Street, and I paid about $200 for the information, but I got the point system for the VIX. So I use that. There's a couple articles out there with Seeking Alpha that you can look up. I don't know if you're gonna. I had to dig pretty deep to find them.